I'm pleased that you're here in such numbers as well tonight. That's very nice to see, because to repeat what Martin said to some degree, we only endeavour to do two things at Fundsmith, which is run your and our money as well as we possibly can, and communicate with you. And we think the latter is very important indeed. We think that in order to get the best from the strategy that we're endeavouring to employ, it's important that you understand what it is we are and equally what it is we're not doing, and what results you might get from that. Because if we don't, then from time to time, either of us could make decisions which are detrimental to our long-term performance in this regard. So communication is very important, and by having this meeting, what we hope is that to some degree, at least, the communication will be two-way, which we'll try and do a bit later on. Undoubtedly, the most important subject to touch upon is the performance of the fund. That's the table which shows the performance since inception to the end of February, as you can see over on the right-hand side. There you can see that the fund is up 47.8% since inception. Actually, I think it's up 49.6% today. We failed to get it to go to just 50% up, which would have been a nice take on the meeting, but there we are. These things we don't do precision landings. Versus the equities, which is shown there. That's for the sake of comparison, we take the Morgan Stanley Capital International Index in sterling with dividends reinvested. So the comparison we're making is with the T class, in which I and the majority of you are invested, which is the accumulation class. And you can see that we are basically up 47.8% against a market, if you like, that was up 29.4%. It's been a very strong period for bonds for most of this, and a lot of hand-wringing concerns about whether or not there's a bubble in bonds and whether a great rotation is or should take place into equities. Bonds are up 16.5%, which is pretty extraordinary during the period. Obviously, we outperformed that, and cash. If you kept much of your money in cash, you'd have been pretty disappointed by the outcome so far. If you annualise that, as you can see, we've annualised 18.3% per annum. The market has annualised about 11.7% per annum. And you can see that bonds have done about 6.8% over there. Looking at the individual years for a moment, last year, which I suppose is the one that probably we're most focused on sitting here today, we were up 14.2%. And you can see the market was up 12.7%. So we outperformed it by a small margin. I've got to say I'm slightly surprised that we outperformed it at all. And if you read my annual letter, you'll see that I expressed that surprise. We're not trying to run a fund that will outperform the market every reporting period, every quarter or every year, or in all market conditions. And if you expect that, then I think at some point you will be disappointed. And frankly, I think if you seek that in other fund managers, I know you're going to be disappointed. Because there is no such human being in my experience. And my experience is about 39 years in the industry, one way or another this year. There isn't somebody who is capable of outperforming in every reporting period and every market condition, or if there is, I must have just not stumbled across them in 4 decades, I suppose. What we seek to do is to actually perform very well when markets are relatively poor, frankly, but still by being fully invested to have a respectable performance when they go up, but maybe not market matching. So you can see if you look at our individual years, our best year was 2011, our first year, when we were up 8.4% and the market was down 4.5%. That's the sort of performance that I tend to expect, that we will very significantly outperform very poor markets. And I'm pleased to say that in 2012 and to date in 2013, you'll see that we've outperformed a very sharply rising market. And as I say, the reason for my surprise there is the things that we seek to own are very defensive companies, if you want to use the jargon of the trade. They are companies that supply or service our everyday necessities and luxuries. They're not the sort of things that do well during great cyclical upswings. So they're not real estate companies and banks and very heavily cyclical businesses. And so it's modestly pleasing, I suppose, that they've performed so well during a period when the market itself was so strong. So that's the performance that we've delivered so far. I hope it pleases you, but frankly, you're the judges in the end. When I was an analyst, one of my pet hates was meetings I went to with managers who told me that their figures were very good. I thought it was my job to decide that. And so it's your job to decide this, basically. If you are pleased, then we're pleased, because you must be the ones who make that decision, basically. The fund has grown in size. As you can see there, we have about £1.2 billion under management now, which is significantly larger than the day we started when I put 25 million of my money into the fund, which I've still got in and some more, because apart from the growth in its value, I've actually put some more money in during the period. One of the questions that often gets asked, and I guess I might be heading off one of our questions later here, but I'm sure there'll be others, is there some cap on the size of the fund? Are you worried about its growth and so on? I mean, ultimately, the answer must be yes. Every investment strategy that's ever been discovered or devised has some kind of limit to it. But I don't think we need worry about it at the moment. The companies we invest in, by and large, are very big companies. The average market value of a company that we invest in is about £49 billion at the moment. And if you do the arithmetic, if we owned 1% in each of the companies that are within our portfolio at the moment, we would have a £13 billion fund. Now, I would suggest that a 1% holding is not a particularly illiquid position. So I don't think we need worry about a ceiling with regard to amount of funds in the near future. If there's to be a ceiling, and I think there's likely will be at some point, it's a ceiling that will be governed by something other than the amount of money. I think it will be governed by this, by the amount of people that we can or wish to deal with. As I said in echoing Martin's remarks, I think this is a strategy which is relatively unusual, perhaps surprisingly, but it is, and certainly not plain vanilla. And therefore it requires quite a lot of communication between us for us all to understand what it is we are and aren't doing, so that people can actually roll with the various, what I call character testing deviations that we'll encounter on our journey together. And that means, I think, there's a limit on how many people ultimately we'll be able to deal with and communicate with. We have, I think, Mark wouldn't know the numbers better than me, but about 6,000 investors at the moment, which is quite a lot. And our team at the moment is a team which is split roughly three ways between those of us who manage the money, those of us who run the administration of the business, and those of us who handle the marketing of the business. But we've no wish in the end to become something which is basically an administration machine with a small sort of group of people in the corner who run the money. And so I think the limit that we will seek to impose at some point is when we find that we're actually creaking at the seams in terms of the number of people that we're having to deal with. So that's where I think the size thing comes in. Whilst on size, I should also mention costs. One of the most important and frequently overlooked factors in the investment performance that you get is how much people charge you or spend on your behalf when it comes to managing your money. And if you look at the moment, my guess, for what it's worth, is that the average UK investor who uses an investment advisor, a wealth manager or whatever, and pays them a fee, that investment advisor uses a platform to marshal the investments, which charges a fee or gets a trail commission, and they pay a fund manager at the end, maybe 1.5%, which is at the moment still the norm for this industry roughly. They're probably shelling out somewhere in the region of 3% per annum, would be my guess. Now, it may or may not you may or may not have noticed that is in fact higher than the yield that you can get on equities at the moment or bonds, which means if you're paying that, 100% or more of your income is being consumed in costs. That, in my view, is not a viable position, and I've no doubt one way or another over time that will change, and I hope what we do makes a small contribution to engineering that change as it comes. But what's our own performance like in that regard? Well, if you're in the T class, which I'm in, we charge you 1%. For your investment. Our so-called OCF, ongoing charges figure, which I believe was known as the total expenses ratio until recently, my colleagues tell me, last year was 1.16%. So we spent 0.16% more than the annual management charge in running the fund for you. The vast majority of what we paid in that regard were basically things linked to the custodial nature of the fund. In other words, it was caused by activity by you, our investors. When you do things, we have to pay a charge to get that administered. So that's the primary spend that we make on your behalf in running the fund. And I think you'll find that's low. My suggestion to you is 1.16% is pretty low. And that's the comparison, I think, perhaps you should be making when you're comparing costs of funds, is that ongoing charges figure or total expenses ratio rather than simply the management fee. For what it's worth, our guesstimate this year, given that our fund has grown, is if it stays at about its present size, our total costs will drop about 3 so-called basis points to about 1.13%. Why? How? Well, some of the people that we pay are fixed costs. Or at least they don't know that yet, but they will be fixed costs. Trust me. Our CFO will take care of that, and so their charges will not be permitted to rise in line with our assets under management, and so we will be able to reduce the amount that it costs you. Unfortunately, that's not the whole cost of people managing funds. The total expense ratio or ongoing charges figure does include the annual management charge and the administration of the fund. The one thing that it doesn't include for our fund or for any other fund is the cost of dealing on your behalf. And this is another thing which I think is almost universally overlooked by investors. Most people might think to look at the annual management charge. A few think to look at the so-called TER or OCF. Almost none of them look at the cost of dealing. And according to the last FSA occasional paper on this, the average fund manager in the UK turns over his or her portfolio about 80% per annum. And I would guess that they are adding, by doing that, another cost, which is hidden, not shown in those figures that I've just been quoting to you, of about 1 to 1.5%, which comes out of the performance which is being delivered by the share prices and dividends of the companies which you own. So that's another drag to bear in mind in terms of your investment performance. It's almost you almost think of giving up at this point, don't you? But what's our performance like in that area? Well, you'll know that some of you will know that one of the hallmarks of what we're endeavouring to do is to buy very good companies, and then to try not to deal in them at all, if we possibly can. And we always try to not deal at all, but we never quite manage to accomplish it. Last year, our voluntary dealing in companies, not including inflows into the fund, obviously, which we've got to invest, because if you took the inflows as part of the turnover, clearly in our first year we'd had 100% turnover. But if you X out the inflows and outflows to the fund, which is the correct way of doing it, our turnover last year was 0.48%. So we turned over less than 0.5% of the fund, and our total dealing costs were 1 basis point, 0.01%. It's a black armband day for the broking industry if this catches on, I've got to tell you.